Before we jump in, I do earn a referral fee when you use the services and companies I demonstrate in the video, but there is no additional cost to you. I chose them because they're the best in the industry and you're safe with them.
Venture capital, fueling the future. Imagine a world without Google, Amazon, or Apple. These companies, now household names, were once just ideas in the minds of ambitious entrepreneurs. These giants started as small ideas with big dreams. They were nurtured and supported through the critical early stages of their development. Venture capital provided the fuel to turn these dreams into reality. It acted as the lifeline that enabled these companies to grow and scale. VC is a form of financing that supports innovative startups with high growth potential. It is the engine that drives innovation and economic growth. These startups are often developing groundbreaking technologies or disrupting existing industries. They are the pioneers of tomorrow, shaping the future with their bold ideas. Without VC, many of the products and services we rely on today might not exist. The impact of venture capital is far-reaching and transformative. VC is not just about funding, it's about partnership. It's about building a relationship that fosters growth and success. VC firms bring more than just money to the table. They provide strategic guidance, industry insights, and valuable connections. They offer expertise, mentorship, and a network of contacts. This holistic support system is crucial for startups to navigate the competitive landscape. This support is invaluable for young companies navigating the challenging path to success. It helps them overcome obstacles and seize opportunities. In essence, VC acts as a catalyst, propelling promising startups towards their full potential. It is the driving force behind the next generation of industry leaders. Inside the world of venture capital funds. Venture capital firms pool money from various investors, creating a substantial fund to invest in high-potential startups. These investors, known as limited partners, can be wealthy individuals, pension funds, or endowments. They provide the capital, but do not get involved in the day-to-day operations. The VC firm acts as the general partner, managing the fund and making investment decisions. They are responsible for identifying and evaluating potential investment opportunities. They identify promising startups and invest the fund's money in exchange for equity, becoming part owners. This equity stake gives them a significant interest in the success of the startup. The VC firm then works closely with the startups in its portfolio, providing guidance and support. This can include strategic advice, operational assistance, and access to a network of contacts. The goal is to help these companies grow and eventually achieve a successful exit. This growth phase can be challenging and requires a lot of resources and expertise. An exit typically involves selling the company to a larger corporation, which can provide the startup with additional resources and market access, or going public through an initial public offering, which allows the company to raise capital from public investors and provides liquidity for early investors. The profits from a successful exit are then distributed among the fund's investors, rewarding them for their risk and patience. This cycle of investment, growth, and exit is the essence of venture capital. The funding journey, from pitch to partnership. This is the story of how startups transform their ideas into reality with the help of venture capital. Getting funded by a VC is a highly competitive process. It requires not just a great idea, but also a well-thought-out plan and a strong team. It starts with a compelling pitch, a concise presentation highlighting the startup's value proposition, target market, and growth strategy. The pitch must capture the essence of the business and its potential to scale. If the pitch resonates with the VC firm, a series of meetings and due diligence follow. These meetings are crucial as they allow both parties to understand each other better. The VC firm will scrutinize the startup's business plan, financial projections, and management team. They will look for red flags and assess the startup's readiness for growth. They will also conduct market research to assess the viability of the startup's product or service. This involves understanding the competitive landscape and potential market demand. If everything checks out, the VC firm and the startup will negotiate the terms of the investment. This is a critical phase where both parties must agree on the future direction of the company. This includes the amount of funding, the equity stake the VC firm will receive, and any other conditions. Once the deal is sealed, the partnership begins, paving the way for the startup's growth and success. The paper trail agreements and legal frameworks. The funding process culminates in a legal agreement known as a term sheet. This document outlines the key terms of the investment, including the valuation of the company, the amount of investment, and the rights of both the investor and the company. It is crucial for entrepreneurs to understand all the terms and conditions before signing. Once the term sheet is signed, lawyers for both parties draft a formal investment agreement. This legally binding document outlines the details of the deal, including the rights and obligations of both parties. This is a critical step in the process, as it protects the interests of both the investor and the company. Navigating the tax maze. Strategies for success. Startups must be mindful of the tax implications of VC funding. The structure of the investment, the type of entity the startup is, and other factors can significantly impact the tax burden. For example, certain corporate structures like limited liability companies or LLCs can offer tax advantages. Consulting with tax professionals is crucial to optimize tax strategies and minimize liabilities. They can help navigate complex tax laws and identify potential deductions and credits. This proactive approach can save startups significant money in the long run, allowing them to reinvest more capital back into their growth. Corporate structure. Choosing the right fit. The choice of corporate structure is a critical decision for any startup, especially those seeking VC funding. The most common structures are sole proprietorships, partnerships, LLCs, and C corporations. Each structure has its own legal and tax implications. LLCs are particularly popular among startups because they offer the liability protection of a corporation with the tax benefits of a partnership. C corporations, on the other hand, are more complex but offer advantages when it comes to issuing stock options, which can be a valuable tool for attracting and retaining talent. Success stories, VC-powered growth. Numerous success stories illustrate the transformative power of VC funding. Take Amazon, for example. Jeff Bezos secured early-stage funding from Kleiner Perkins Caulfield and Byers, a prominent VC firm. This investment allowed Amazon to scale its operations and become the e-commerce behemoth it is today. Another example is Google. The tech giant received funding from Sequoia Capital and Kleiner Perkins Caulfield and Byers in its early days. This investment enabled Google to develop its search engine and expand its offerings, ultimately revolutionizing how we access information. Section 8. The VC Influence, Shaping Business Strategy. VC funding often comes with a seat on the company's board of directors. This gives the VC firm a voice in strategic decisions, influencing the company's direction and growth trajectory. While this can be beneficial, providing access to valuable experience and networks, it's essential for entrepreneurs to maintain a clear vision for their company. Open communication and a shared understanding of goals are crucial for a successful entrepreneur-VC relationship. The ideal scenario is a true partnership, where both parties work collaboratively to achieve a shared vision of success. This synergy between capital and innovation is what drives the most remarkable VC-backed success stories. Seeking funding, tips for entrepreneurs. For entrepreneurs seeking VC funding, preparation is key. Start by crafting a compelling business plan that clearly articulates your value proposition, target market, and competitive advantage. Develop a strong pitch deck that effectively communicates your vision and persuasively presents your business opportunity. Network strategically and attend industry events to connect with potential investors. Research different VC firms to identify those that align with your industry and stage of development. Be prepared to answer tough questions about your business model, financials, and team. The future of VC trends and predictions. The VC landscape is constantly evolving. New technologies, emerging markets, and shifting economic trends are shaping the future of venture capital. One notable trend is the rise of impact investing, where VCs are increasingly looking to back companies that generate both financial returns and positive social or environmental impact. Another trend is the growing interest in artificial intelligence, biotechnology, and clean energy. VCs are pouring billions of dollars into these sectors, recognizing their potential to disrupt industries and address some of the world's most pressing challenges. Section 11. Conclusion: embracing the VC opportunity. Venture capital plays a vital role in fostering innovation and economic growth. By providing capital, expertise, and networks, VCs empower entrepreneurs to transform their bold ideas into successful businesses. Understanding the intricacies of VC funding, from the initial pitch to the legal and financial considerations, is essential for entrepreneurs seeking to embark on this journey. As the VC landscape continues to evolve, embracing new trends and adapting to changing market dynamics will be crucial for both investors and entrepreneurs. By working together, they can continue to drive innovation, create jobs, and shape a brighter future for generations to come.